Welcome to this episode of Mo Money. I'm Alexander Palmaris, your host, and today we have Daryl Montgomery with us again, who heads up the New York Investing Meetup. He currently has about 1,200 members who listen attentively once a month to all of his perspectives on the markets and the Fed's actions and the economy in general. And we're very happy to have him here with us again.
Thank you for having me, Alex.
And again, I was at the last meeting. You had another fantastic presentation. It was very insightful, and that's again why I wanted to bring you on here. You had a great response last time. Also, people were very receptive to your thoughts on the economy and the markets and how the Fed kind of does its thing. And I thought it might be another good opportunity to start out. Let's maybe talk about what's happened since the Fed rate cut back in mid-September.
Well, Alex, the most significant thing is what happened to the U.S. dollar after the Fed meeting. The dollar fell against almost every currency in the world, and that includes some of the currencies that were the weakest currencies years ago, such as the Philippine peso, the Turkish lira, the Botswanan pula, the Brazilian real, the Indonesian rupiah. I mean, people spoke with one very loud reaction, and that reaction is, I want to get out of U.S. dollars, no matter where they were in the world. You also see the trade-weighted dollar, this is the dollar against a whole basket of currencies, hit at least 3 new all-time lows since the Fed meeting. And this, of course, is incredibly, incredibly negative, and it also indicates a lot of inflation is on the way. What you also saw, the Fed did this rate cut. The excuse for it was to help mortgage holders, and particularly subprime mortgage holders. So did the mortgage rates actually go down? No, they did not.
Actually, I think the longer rates went up after that, didn't they?
The fixed rate mortgages actually went up after the Fed meeting. So this certainly did not help homeowners at all. The Fed did manage to help some people, however. The people who were engaged in private equity, who the big hedge funds and the big banks, this market became partially unfrozen. So you could say the Fed action was helpful to rich hedge fund owners and the banks and brokerage houses. And the stock market, of course, rallied in the United States, and it turns out not just for the United States. So Wall Street was quite happy with this move. However, if you look at it closely, there was lots of problems with the stock market rally. For instance, it has taken place on very low volume, and particularly below average volume. Now, from a technical perspective, this is very negative, and this indicates the rally is not going to continue, or could simply just fall apart at any point in time for any reason. So, I mean, although the Fed seems to have helped the stock market, this remains to be seen how long that will last.
There's another thing that's kind of interesting here, too, is, suddenly we're seeing all of these big banks and brokerage firms announcing record earnings. But at the same time, they're also announcing massive write-offs, which almost seem to have been completely forgotten about.
Well, they were basically not ignored, Alex.
Ignored.
What happened, there have been announcements of very large write-offs. Merrill Lynch about $5.5 billion, that's just for this quarter. UBS, $3.4 billion. Citibank, $3.3 billion. Deutsche Bank, $3.1 billion. These are just a few examples.
Well, who's keeping track? I mean, once you get that much money, what's a few bad loans, I guess?
Well, Wall Street, that's how Wall Street reacted, Alexander. It's like, oh, these are just all the write-offs, and this is all it's going to be, and we've gotten it out of the way. Well, this subprime crisis is going to go on at least 2 or possibly 3 more years, so this is just the beginning. It's not the end. And it's not just subprime. This crisis is includes all financial assets, and it includes a lot of business borrowing, it includes a lot of business mortgages, credit cards, car loans, etc. And we've yet to see the damage from that at all. Very interesting, the Deutsche Bank announcement, even though they're writing off $3.1 billion, they also announced their earnings would still go up for the quarter.
Well, that's shocking to me.
Well, it's quite amazing. Certainly, how could a company do this? And they said in their announcement that they were going to have some use some tax credits, sell some assets. But this is basically just manipulating your earnings and it's truly meaningless and if not even extremely negative. And nevertheless, the stock went up quite a bit during this announcement. One other thing, the large rally we've seen in the stock market has been led by the financials. They have gone up far more than any other group of stocks, even though their future certainly looks very, very dim, and their earnings in the near future or even the midterm future, meaning a few years, also look pretty dim. Basically, I consider it just to be sort of short covering. In fact, we've gone to new highs based on short covering, which doesn't make sense. And if you look at a chart, you will actually see that the market hit new highs, the day it first hit new highs, which is called a breakout, took place on below average volume. This is extremely unusual. It is also extremely negative. It indicates a very weak and very iffy rally. And another thing that has happened since the Fed rate cut, S&P has lowered its earnings estimates for the top S&P 500 companies, and they are now actually earnings growth is negative, which means they expect earnings to decline. Now, the stock market should go up if earnings are getting bigger and bigger. It should be going down if earnings are declining. And this is another potential danger to this rally. This is another thing that people should pay attention to. The August job cuts were a big surprise, and this created a big political movement to get the Fed to cut its rates. But when the September report came out, all of these numbers were suddenly and rather magically revised upwards. We will have a talk on that, but it looks like not only the reports were highly, highly manipulated, they do not make any sense statistically. And you would have to ask yourself, why did this happen? But if you look at other government economic reports, you will see a lot of them don't make any sense, and 2 and 2 frequently does not add up to 4.
You would think that someone would be able to make an accurate estimation, at least of how many jobs are available out there.
Well, we would indeed think that, but apparently that's not happening, or it's either accidentally or purposely. That's really up to the viewers to decide.
I think we'll leave it at that for this episode. I thank Darryl for his time and sharing this information with us, and we look forward to the next episode.
Thank you, Alexander.
Thank you, Darryl.